Term versus perm. This is Corey Ankerson from Legacy Tax and Financial Planning, and today I'm going to talk about term insurance versus permanent insurance. I'm going to go over the pros and cons of each and talk about which one is best for you and your family. Let's talk about it. All right, let's start with term life insurance. Term life insurance is pretty simple. It's easy to understand. It's an insurance policy that's going to cover you for a limited period of time, usually going to be 10 years, 20 years, 30 years. It's going to provide you benefit for that period of time. It builds no cash value, so it's what they call pure insurance, right? I call it pure expense because it doesn't offer any benefit to you other than the death benefit that's going to be there, right? People buy term insurance because it is relatively cheap, right? It's affordable, right? If you compare the cost of a term life insurance policy to the cost of a permanent insurance policy, term insurance is always, or almost always, going to be cheaper. It's normally going to cost less. Your monthly outlay is going to be lower. So that's pretty much the only reason that someone would buy term, right? The downside of buying a term life insurance policy is that at the end of that 10-year, 20-year, 30-year period, you will no longer have insurance, right? You no longer have coverage. So if you're a 45-year-old man and you purchase a term, let's say a 20-year term life insurance, at the end of 20 years, when you're 65 years old, you no longer have insurance coverage. Your term policy would lapse at that period of time. You're no longer covered. Alternatively, some companies have provisions where the policy doesn't lapse, but the premium goes up to such a degree that you can no longer afford to keep it. So essentially, it lapses, right? It becomes so unaffordable that no one can afford to have it, right? A permanent policy, on the other hand, comes in many different flavors, right? You got whole life, you got your universal life, you got indexed universal life, and there's variable universal life as well. All of those are permanent policies. The essence of a permanent policy is that, as the name implies, it's permanent. It lasts for your entire life, right? You're going to take out the policy when let's say you're 30, 40 years old, and it's going to be there until you die, or your whole life. The other benefit of a permanent policy is that they normally are designed to build cash value. How much cash value? It depends on how the policy is designed and what its intended use for, but typically a permanent policy will build some cash value within the plan. It's not a substitute or a replacement for investments like mutual funds or things like that, but they will build some cash value within the plan. The drawback to a permanent policy is that they're going to cost more, right? So just like we said a moment ago, that term is a little bit cheaper. A permanent policy is going to cost a little bit more. So with a term policy, you would be able to get a larger death benefit or higher face amount for the same premium that you might pay for a permanent policy. Alternatively, you could get you could pay less, and get the same amount of coverage, or you could pay the same amount and get a larger coverage with a term policy. That's the way that they work. Whereas a whole life, you're going to pay a little bit more. A universal life, index universal life, VUL, you're going to pay a little bit more for the same amount of coverage. However, like I said, it's going to be permanent, and it's going to last you for your entire life, and it will also, like I said, build cash value. So those are the trade-offs, the pros and cons. To make the point, let's consider the example of two brothers, both age 45 and in normal health. Each brother needs $350,000 of life insurance coverage. Brother A chooses a 30-year term policy with a $350,000 face amount, or death benefit. He pays $136 a month, or $1,638 per year. Brother B chooses a permanent policy with a $350,000 face amount. He has a monthly premium of $490 a month, or $5,883 per year. As you can see, the permanent policy has a higher monthly cost, but as the old saying goes, you get what you pay for. And as we'll see later, the permanent policy also offers much greater benefit as well as value. However, if you can't afford the monthly payment, then you should definitely consider a term policy as opposed to a permanent policy. 30 years later, Brother A has reached age 75 and his 30-year term has expired. He has outlived his policy and no longer has coverage. If the policy lapses and he dies the very next day, his family receives nothing, and 30 years of monthly premiums go down the drain. It's important to note that term life insurance doesn't always expire at the end of the term period. What does expire, however, is the low rate that you've been paying. The term period is set when you purchase the policy and typically lasts for 10, 20, 30, or even 40 years. After that, you can usually continue the policy on a year-to-year basis, but the policy's cost will increase substantially every single year, which usually makes it more expensive than a permanent policy and unaffordable for most people. Once they become unaffordable, the vast majority of term policies lapse due to non-payment. Now that's beyond the scope of this video, but I'll do another video explaining how term policy premiums increase over time. Now, Brother B has reached the age of 75 also. And because he bought a permanent policy, his coverage will remain in force for as long as he lives, assuming he continues to pay the required monthly premiums. Not only is his coverage still in place, his net death benefit has actually grown to $399,227. During the 30-year period, Brother A has paid nearly $50,000 in policy premiums and now has no death benefit. And because it's a term policy, he also has no cash value. But look at Brother B. Not only is his death benefit still in place, but he has built a significant cash value in his policy. He has $373,109 in cash value, which he can use to supplement his retirement, pay off debt, or do whatever he wants. And if his policy is structured correctly, he can access that money tax-free. Even after you subtract the $176,505 in total premiums paid, he has a net cost that is significantly lower than the term policy. But how much lower? The term policy has a net cost of $49,160. The permanent policy has a net cost of zero. That's right, zero after 30 years. The permanent policy has $373,109 in cash value. That means that after 30 years, Brother B could decide to cancel his policy and actually receive a check from the insurance company in the amount of $109. That's $373,109. Even after you subtract the total premium of $176,505, the permanent policy still has $196,640 in net cash value. The net cash value is simply going to be the difference between the cash value that exists in the policy minus the total premiums paid. So Brother B actually got back more than he put in. That's why I say that the net cost of owning a permanent policy can actually be zero, even though the monthly premium is actually higher, in some cases significantly higher. So as we can see, term insurance is going to offer you a lower monthly premium. It's cheaper, right? It's just cheaper to buy term than it is to buy permanent. However, a permanent policy is generally going to be a better value despite the fact that it costs more money per month. Why? Because a permanent policy, if it's structured properly, will typically produce enough cash value to offset the increased amount of the monthly premium. So it just comes down to that. Are you looking for the cheapest possible policy, or are you looking for the greatest value in the coverage that you're going to ultimately purchase? And then when you're looking at life insurance plans, there's other things besides the monthly premium, right? There's other things besides the cost. Just like when you're buying a car, right? Are you looking for the cheapest possible car, or are you looking for the best value that's out there? And so it is with life insurance. You want to look at things like how much death benefit do you need, or how long do you think you'll need the coverage, or what uses are you using it for? Is it for income replacement? Is it to help mitigate taxes upon your death? Things like that. So that you need to consider all those things, not just the monthly price. Okay. If you have any more questions or you want to learn more about different life insurance plans, please visit our website at legacytfp.com. That's legacytfp.com. You see it down below. And don't hesitate to give us a call at 301-572-4840. Again, that's 301-572-4840. You can reach out to us on Facebook, on Instagram, and definitely in the comments below to this video. We do answer comments. All right. Look forward to hearing from you all soon. Talk to you later. Bye-bye.